May 2025 was no ordinary month. War broke out, oil spiked, rates moved, and headlines screamed panic. But while the world watched in fear, the market quietly taught us 10 powerful lessons every investor needs to hear. Lesson 1. Markets don't always react to geopolitical events. Imagine waking up to the headline, India enters war with Pakistan. Your instinct might say, sell everything. But in May 2025, when this actually happened, the Indian stock market barely flinched. The Nifty posted its third straight monthly gain. So why didn't the market crash? The answer lies in what truly moves markets: earnings visibility, economic momentum, and liquidity. Investors didn't panic because India's GDP growth was strong at 7.4%, inflation was under control, and the RBI had just cut interest rates to stimulate the economy. Meanwhile, across the border, Pakistan's stock market plunged 7.6%, triggering a trading halt. Their markets lacked the economic cushion, and investors reacted accordingly. The key takeaway: markets don't respond to headlines. They respond to underlying strength. Markets fear uncertainty, not war. If growth is strong and liquidity is flowing, investors stay calm. Lesson 2. Crude oil prices are not always a villain for India. We often hear, rising crude oil prices are bad for India, sell stocks. But in May 2025, crude jumped 10% to $86 per barrel, and the Indian stock market kept rising. Why? Because the impact of oil isn't one-dimensional. India now has a stronger macro setup than before. Forex reserves are high, the rupee is stable, domestic inflation is under control. Also, a weaker China meant less global demand for oil, which helped stabilize prices, and India, being more energy efficient than it used to be, could handle temporary spikes without derailing growth. In short, crude oil is important, but it's not a trigger by itself. Its impact depends on other moving parts: demand, inflation, FX, growth. Don't let fear headlines fool you. Look at the complete economic picture. The key takeaway: oil prices matter, but only when they hurt inflation, growth, and the rupee. Context is everything. Lesson 3. Rate cuts alone don't spark market rallies. When central banks cut interest rates, everyone expects markets to fly. But here's what really happened in May 2025. The RBI cut rates by 25 basis points, the first cut since 2020. Yet bond yields rose, and markets barely reacted. Strange, right? Here's why. The rate cut was already priced in by investors. Markets had anticipated it weeks ago, based on falling inflation and growth data. This is a classic investing lesson. Markets are forward-looking. By the time a rate cut is announced, smart money has often moved ahead, repositioning portfolios before the news hits. Also, one small cut isn't a game changer unless it's part of a larger easing cycle. The RBI was cautious, not aggressive, so markets didn't cheer. It's not just the news. It's how unexpected and how deep the change is that moves markets. The key takeaway? Markets don't react to news. They react to surprises. If it's already expected, it's already priced in. Lesson 4. The US market can climb even when economic growth slows. Here's a head-scratcher. In May 2025, the US economy showed clear signs of slowing. GDP estimates dropped, inflation cooled, and job growth softened. And yet, the Nasdaq surged to all-time highs. The S&P 500 was up 15% YTD. So what's going on? 2 words: AI optimism. Even though macro indicators weakened, investor excitement around artificial intelligence, AI, kept US tech stocks soaring. Big names like Nvidia, Microsoft, and AMD pulled the entire index upward. This is a classic case of narrative numbers, where the theme of the future outweighed current weakness. Markets aren't just driven by data, they're driven by what investors believe is coming next. And right now, investors believe AI is a long-term growth driver, and they're betting ahead of time. The key takeaway: markets don't just track today's economy, they price in tomorrow's potential. Lesson 5. India's market strength is backed by solid fundamentals. In May 2025, while global headlines focused on war, oil, and rate cuts, India's stock market kept climbing quietly. But here's what really mattered, and why it wasn't just luck. India's fundamentals are rock solid right now. Earnings growth is strong across sectors. Credit growth is above 20%, a sign of healthy business activity. Rural demand is rebounding, and core inflation remains in control, giving room for policy flexibility. In other words, this is not a sentiment-driven rally. It's supported by real numbers and broad-based participation, not just tech or large caps. Even midcaps and smallcaps are contributing, something you don't see unless the market has deep confidence in economic momentum. So while the noise outside gets louder, India is quietly compounding, one earnings report at a time. The key takeaway: the best market rallies are powered by earnings, not emotions. Lesson 6. Midcaps and smallcaps are rallying for the right reasons. In past bull markets, smallcaps and midcaps often surged because of speculation, not substance. But this time in May 2025, their rally is fundamentally justified. Here's why. Earnings growth in mid and small caps is real, not hopes, but actual profit numbers. Balance sheets are stronger, less debt, better cash flows. Corporate governance has improved, and many companies are now more transparent. And most importantly, retail participation has matured. Investors are not just chasing momentum, they're looking at real businesses. This shows a major shift. The small and mid-cap space is evolving from being frothy to being respected. That means future returns from this segment could be more sustainable because they're being built on earnings, not just euphoria. The key takeaway: small doesn't mean risky, not if the earnings are strong and the books are clean. Lesson 7. Don't bet against the market trend. Ride it with logic. One of the most common mistakes investors make is fighting the trend. In May 2025, some experts kept saying, "This rally can't last, it's too fast, too high." Others waited on the sidelines for a correction that never came. But here's what smart investors did instead. They rode the trend with logic. They followed leading indicators: earnings momentum, sector rotation, liquidity flows, institutional buying. Because in markets, trend is more than emotion. It's often a reflection of underlying strength. Trying to predict when a bull run will stop can cost you big opportunities. The key takeaway: you don't have to be early, you just need to be in with a process. Lesson 8. Liquidity moves markets, not just fundamentals. Most of us learn early that fundamentals drive stock prices. That's true. But there's another powerful force at play: liquidity. In May 2025, the Indian market's strength wasn't just because of good earnings. Foreign institutional investors were back, pumping Rs 24,000 plus CR into Indian stocks. Mutual funds saw steady inflows through SIPs. Retail investors remained active, supporting the rally. This flood of liquidity created a floor for the market, even when valuations looked stretched. Because when money chases a limited number of quality stocks, prices rise, even without perfect fundamentals. That's not to say fundamentals don't matter. They do. But liquidity decides the pace and mood of the market. Smart investors track both. The key takeaway? Strong businesses rise long-term, but it's liquidity that lights the short-term fire. Lesson 9. Retail investors are smarter and more disciplined than ever. Not long ago, retail investors were seen as reactionary, buying high, selling low, chasing rumors. But May 2025 proves just how far we've come. Despite global uncertainties, Indian retail investors kept investing steadily. SIP flows stayed strong, panic selling was minimal, participation spread across sectors, not just trending stocks. What changed? Today's retail investors are more informed, thanks to YouTube, newsletters, and data access. More disciplined, sticking to SIPs and asset allocation. More patient, willing to hold quality stocks for long-term gains. They're not just following tips. They're building strategies. They're compounding wealth, quietly, systematically. And this makes India's market structure healthier and more resilient than ever before. The key takeaway? Retail investors aren't the weak hands anymore. They're the backbone of the bull market. Lesson 10. Build a process that can withstand the storms. Markets will always throw storms your way. War headlines, oil shocks, inflation spikes, political chaos. But your portfolio shouldn't shake every time the news does. May 2025 taught us that successful investors don't react emotionally. They follow a clear, disciplined process. Here's what that looks like. They filter companies by real earnings, not noise. They stay invested through volatility, adjusting only when data demands. They build portfolios with a blend of safety and smart risk. And most of all, they let time and compounding do the heavy lifting. This isn't luck, it's preparation. It's process. When markets get messy, your process becomes your anchor. Takeaway: you don't control the storm, but you do control your system. Stick to it. May 2025 will be remembered. But why? We'll remember May 2025 as a month full of headlines. War, oil, AI, rate cuts. But what matters most is the lessons it leaves behind. Because the best investors aren't just watching, they're learning. They're building portfolios based on earnings strength, long-term narratives, liquidity awareness, emotional discipline, and a repeatable process. If you found value in these 10 lessons, like the video, subscribe for smarter investing content, and share this with someone who's navigating the same market noise. Stay calm, stay focused, keep compounding. Your future self will thank you.